Welcome back to our channel. Today we're diving into a crucial topic for anyone interested in investing: asset allocation. Whether you're a seasoned investor or just starting, understanding the principles and nuances of asset allocation is vital to navigating the complex world of finance, especially as the global economy continues to experience shifts and changes. Asset allocation is, in essence, the strategy of distributing your investment portfolio across different asset categories such as stocks, bonds, real estate, and cash. The primary goal of asset allocation is to balance risk and reward by diversifying investments according to an individual's goals, risk tolerance, and investment horizon. However, the effectiveness of any asset allocation strategy can vary significantly depending on the prevailing economic environment. What is asset allocation? At its core, asset allocation involves the strategic division of your investment portfolio among various asset classes. These classes typically include equities, stocks, fixed income, bonds, real estate, commodities, and cash or cash equivalents. Each of these asset classes carries its own level of risk and potential return, and they respond differently to changes in economic conditions. For example, stocks have historically offered the highest potential returns, but they also come with the highest level of risk, particularly in volatile markets. Bonds, on the other hand, generally provide lower returns but are considered safer investments, offering more stability during economic downturns. Real estate can provide a steady income stream and potential for capital appreciation, while cash equivalents offer the lowest risk but with minimal returns. The importance of economic environment in asset allocation. The economic environment plays a pivotal role in determining how different asset classes perform. Whether the economy is in a period of growth, boom, contraction, recession, or recovery, each stage of the economic cycle impacts asset prices and consequently the effectiveness of your asset allocation strategy. During a booming economy, for instance, stocks often perform exceptionally well as companies see increased profits and investor confidence surges. However, during a recession, when economic activity slows down, stocks can lose value rapidly, while bonds and other fixed income investments tend to hold their value better, providing a safe haven for investors. Understanding how these economic conditions affect different asset classes allows investors to adjust their portfolios accordingly, maximizing returns while minimizing risk. This adaptability is key to long-term investment success. Common asset allocation strategies. Now that we've established the importance of asset allocation and its relationship with the economic environment, let's delve into some common asset allocation strategies. These strategies can be tailored to individual investment goals, risk tolerance, and time horizon, but they generally fall into three broad categories: aggressive, conservative, and balanced. 1. Aggressive allocation. An aggressive asset allocation strategy is designed for investors who seek maximum growth potential and are willing to accept a higher level of risk. This strategy typically involves a heavy emphasis on equities, stocks, with a smaller portion allocated to bonds or other asset classes. Aggressive strategies are most effective in bullish markets, where stock prices are rising. During such times, this approach can yield significant returns as the value of equities increases. However, the downside is that aggressive portfolios are particularly vulnerable during market downturns. In a recession, for example, stock prices can plummet, leading to substantial losses for investors with heavily equity-weighted portfolios. 2. Conservative allocation. In contrast to aggressive strategies, conservative asset allocation focuses on preserving capital and minimizing risk. This approach typically involves a larger allocation to bonds and cash equivalents with a smaller portion invested in equities. Conservative strategies are generally favored by investors who prioritize stability over growth, such as those nearing retirement or with a low tolerance for risk. In a recessionary environment, conservative portfolios tend to outperform aggressive ones, as bonds usually retain their value or even appreciate during economic downturns. However, during periods of economic expansion, these portfolios may underperform compared to more aggressive strategies, as the growth potential is limited. 3. Balanced allocation. A balanced asset allocation strategy strikes a middle ground between aggressive and conservative approaches. It typically involves a mix of stocks and bonds, with the exact proportions adjusted based on the investor's risk tolerance and financial goals. Balanced strategies aim to provide both growth and stability, making them suitable for investors who seek a moderate level of risk. In a booming economy, a balanced portfolio may not achieve the same high returns as an aggressive one, but it can still capture a significant portion of the market's upside. Conversely, during a recession, the bond allocation in a balanced portfolio can help cushion against stock market losses, providing some protection against downturns. Analyzing strategies in diverse economic environments. To truly understand the effectiveness of these asset allocation strategies, it's essential to analyze how they perform in different economic environments. By examining historical data and real-world examples, we can gain insights into which strategies are best suited for various economic conditions. Booming economy. In a booming economy, characterized by strong economic growth, low unemployment, and rising consumer confidence, aggressive asset allocation strategies often shine. The stock market tends to perform exceptionally well during these periods, with corporate profits increasing and investor sentiment remaining high. As a result, portfolios with a heavy emphasis on equities can see substantial gains. However, it's important to note that even in a booming economy, there can be volatility and risks. Overvaluation of stocks or geopolitical events can lead to sudden market corrections. Therefore, while aggressive strategies can be highly rewarding during economic booms, they also require careful monitoring and, potentially, timely rebalancing to avoid excessive risk. Recession. During a recession, the economy experiences a slowdown with declining GDP, rising unemployment, and reduced consumer spending. In such an environment, conservative asset allocation strategies tend to outperform more aggressive ones. Bonds, particularly government and high-quality corporate bonds, often serve as a safe haven during recessions, preserving capital while stocks decline in value. The 2008 financial crisis provides a stark example of how different strategies can fare in a recession. Investors with conservative allocations, particularly those with significant holdings in fixed-income securities, saw less dramatic losses compared to those with aggressive, equity-heavy portfolios. This period highlighted the importance of risk management and the role of bonds in protecting portfolios during economic downturns. Recovery. The recovery phase following a recession is marked by renewed economic growth, improving employment rates, and rising consumer confidence. During this period, balanced asset allocation strategies often prove to be the most effective. These strategies allow investors to capture the upside potential of the recovering stock market while maintaining some level of protection through bonds and other fixed-income assets. For example, after the 2008 crisis, as the global economy began to recover, balanced portfolios generally performed well. Investors who maintained a diversified approach with a mix of equities and bonds were able to participate in the market's rebound while still managing risk. Real-world examples. To further illustrate the effectiveness of different asset allocation strategies, let's look at some real-world scenarios. The dot-com bubble, late 1990s to early 2000s. During the late 1990s, the stock market experienced a massive boom, driven by the growth of internet-related companies. Investors with aggressive asset allocation strategies saw tremendous gains as tech stocks soared. However, when the bubble burst in 2000, those heavily invested in equities suffered significant losses. In contrast, investors with more conservative or balanced portfolios, which included bonds and other assets, were better positioned to weather the downturn. The 2008 financial crisis. As mentioned earlier, the 2008 financial crisis was a defining moment for asset allocation strategies. Conservative investors, particularly those with significant bond allocations, saw their portfolios decline far less than those of aggressive investors. This period underscored the importance of diversification and the role of bonds in preserving capital during severe market downturns. Post-pandemic recovery. Following the economic disruption caused by the COVID-19 pandemic, markets rebounded strongly as governments implemented stimulus measures and vaccination efforts progressed. During this recovery phase, balanced and diversified portfolios generally performed well, capturing the upside of the equity market's recovery while maintaining some level of risk management through bonds, tailoring asset allocation to individual needs. While understanding the general effectiveness of different asset allocation strategies in diverse economic environments is crucial, it's equally important to recognize that there is no one-size-fits-all approach. The ideal asset allocation strategy varies from investor to investor, depending on factors such as financial goals, risk tolerance, investment horizon, and personal circumstances. Financial goals. Investors with long-term goals, such as retirement planning, may prioritize growth and be more willing to accept higher risk through aggressive asset allocation. Conversely, those with short-term financial goals, like saving for a down payment on a house, may opt for a more conservative approach to preserve capital. Risk tolerance. An investor's risk tolerance is a critical factor in determining asset allocation. Those who are comfortable with market volatility and potential short-term losses may lean towards a more aggressive allocation. In contrast, risk-averse investors may prefer a conservative or balanced strategy that offers more stability. Investment horizon. The length of time an investor plans to hold their investments also influences asset allocation. Younger investors with a longer time horizon may choose a more aggressive strategy as they have more time to recover from potential losses. Older investors nearing retirement may shift towards a conservative allocation to protect their accumulated wealth. Personal circumstances. Individual circumstances such as income level, family situation, and health can also impact asset allocation decisions. For example, an investor with significant financial responsibilities, such as supporting a family or managing medical expenses, may prefer a more conservative approach to ensure financial security. Consulting with a financial advisor. Given the complexities of asset allocation and the varying economic environments, consulting with a financial advisor can be invaluable. A professional advisor can help tailor an asset allocation strategy that aligns with your unique financial goals, risk tolerance, and personal circumstances. They can also provide ongoing guidance and adjustments to your portfolio as market conditions change, ensuring that your investment strategy remains aligned with your objectives. Conclusion: the dynamic relationship between asset allocation and economic environments. In conclusion, understanding the dynamic relationship between asset allocation and economic environments is essential for making informed investment decisions. Different asset allocation strategies perform differently depending on whether the economy is booming, in recession, or recovering. By analyzing historical data and real-world examples, investors can gain insights into how to optimize their portfolios for various economic conditions. Ultimately, the effectiveness of an asset allocation strategy hinges on several factors, including the investor's financial goals, risk tolerance, investment horizon, and personal circumstances. Adaptability is key, as the economic environment is constantly changing. By staying informed and working with a financial advisor, investors can craft a strategy that not only meets their current needs, but also positions them for long-term success. If you found this video helpful, don't forget to like, subscribe, and hit that notification bell for more investment insights. We'd love to hear your thoughts or questions in the comments below. Until next time, happy investing!